Hey guys, and welcome to our latest video, Idea Bomb. Have you ever wondered what the cost of your finances are? That's right. I know it's a little strange to think about, but no matter where you keep your money, it costs you something. But the question is, what is it you're buying? When you buy a washing machine or a car, whatever, you know exactly what you're buying and what the cost is. There's a sticker price right there. But when you put money into, let's say, an investment, a mutual fund, or a real estate deal, sometimes it can be really hard to know exactly what the expenses are. Today, we're going to find out exactly how much a bank on yourself type whole life policy costs you and what it buys you. Hello, I'm Mark Willis, certified financial planner, and your guide for the journey in discovering and dispelling the myths of the bank on yourself strategy and exactly what you can use it for. So let's jump into this idea bomb together today. Stay to the end and make sure to like and subscribe to the video so you never miss any of our content we're putting out on a weekly basis. So I will be sticking around when this episode airs to answer any questions. So I'll be looking in the comments right when it airs. So be sure to leave a comment as well. And I'd be happy to answer any questions that you have from this video. All right, let's jump on in. What does it cost to truly buy a bank on yourself type policy? Now, if you have listened at all to any financial infotainers, you'll know for sure that they are not big fans of dividend paying whole life insurance. They say it's way too expensive. It costs way too much. Well, let's see if they're right. Let's take a look at some of the math. First of all, a recap. As you can see here, here's a guy who's 35 years old and he's putting in 40,000 bucks a year, and the money is going to grow on a predictable basis every single year for the rest of his life. Now, the gains are locked in, so every time he gets dividends, which are shown there on the spreadsheet, those don't ever go away. Those are yours for life. Those become part of your guaranteed cash value going forward for the rest of your life. And also, if it's designed correctly, the cash value can be accessed without any taxes due under current law. And that's been the law for 107 years since we've had an income tax in this country. So keep in mind that life insurance actually predates the IRS. Now, let that sink in for a minute. In addition to that, there's obviously, as you can see here, a giant death benefit on the balance sheet for the family. At some point in the future, that family is going to be given a giant windfall and a gift that will matter tremendously for future generations. So that's a quick recap of bank on yourself designed whole life policies. Notice how much cash is available even in the first year. Now, let's be clear, nothing is free. Let's look very clearly at the costs. It's very clear. In the first year, this guy puts in $40,000. Now, let me pull over for a minute. Your numbers are going to be different. Obviously, you could take away a zero from his premium. You could add a zero to his premium and make these your numbers. And it's all fairly proportional. But the point is the concept. And no matter how small or large, there will be insurance costs since that's what we're buying. We're buying a life insurance policy. Let's take a look at the costs. Is it worth it? When he puts 40 grand in the first year, he has a cash value at the end of the year of just shy of 27 grand. That's roughly $13,000 of cost. Now, what did that cost buy him? It bought him a gift for his family in the amount of $1.7 million. Now, notice that death benefit is growing, isn't it? Every year into the future. Also growing is his cash value. In fact, if you look real close, you'll notice the cash value is actually growing at a faster and faster rate every single year. So in the second year, the increase of his cash is actually showing a faster pace than year one. And the increase in his cash from year 2 to 3 is also growing even faster. So the increase of his cash is actually showing a less and less cost, or the fancy word there would be delta between what he paid in and what it increased by. So over the course of the first 3 years, he's paid a total cost, a delta of $27,511. But actually notice, by year 4 to year 5, the annual increase is larger than his annual contribution. He put in $40,000 from year 4 to year 5, but the cash value increased, if you do the math there, $41,755. That's more than he paid in. He gave the insurance company 40 grand. He got back 41,700 bucks of increased cash value. And he had a $2.3 million death benefit. Now, think about this for a minute. At that point, who is paying who for this life insurance? I'll let you think about that for a minute. But if you really stop and look, the increase of the cash is faster than his annual contribution. At that point, the insurance company is paying him to keep this policy in effect, of course, in effect. Now, he's still putting money out of the policy. There are still insurance costs, of course, but the growth of the cash with guarantees built in is now faster than his contribution. Now, let's take a look here. Let's fast forward a few years down to year 36 when he's now 70 years old. And at that point, at age 70, he has $3.1 million of cash value and a death benefit just shy of $6 million to the family. That is incredible. So let's do the math there. He has a total cost of the asset that his family has to incur out of pocket, $27,000, $27,500. Let's just round down and say his death benefit is $5 million because it's growing on a predictable schedule over his lifetime. Let's just say it's $5 million gift to the family. That means approximately 1/2 of 1 cent is expense per dollar he gets to pay his family when he passes away. 1/2 of 1 cent is the cost of insurance over that 36-year period. That is incredibly affordable. And Dave Ramsey says that is way too expensive. Somehow that's way too expensive. I mean, does that sound expensive to you? I'm guessing not. In fact, if you were to look at the mutual fund expense of a typical IRA or 401k, according to the Department of Labor, they say that a 1% assets under management fee will cost the IRA or 401k 1/3 of your life savings over a 35-year period. Meaning if you have a 1% AUM fee on all your index funds and whatnot, it's going to cost you 1/3 of your life savings over 35 years. That's just bananas crazy. So let's finish up here. Now, there's another piece to this that I want to talk about, and that is the dividends. Dividends are paid on this policy. Don't forget, dividends are paid by the insurance company as a kind of profit. All right, so the total dividends, if you were to add up those dividends from years 1 to year 9, would be $27,474. Essentially, everything the person paid for this policy in the first 3 years, he gets it back in the way of dividends. In fact, the insurance company clarifies dividends as a return of premium. And did the insurance company just pay back all of the expense of this policy over 9 years? Yeah. Plus all that cash value. At that point, he's got $373,000 in year 9 of cash value liquid for him. And of course, all the future growth on his money. And of course, the death benefit of $2.7 million. In year 9, he got back all of the expense that he paid into this policy. So at that point, how much does this policy really cost him? I'll let you think about that one for a minute. Now, imagine for a minute, let's just take the life insurance out of the equation. Imagine you bought a house that was worth $5 million and your family could live in that house forever. Now, let's say you only had to pay the seller $27,000 for that $5 million house. That'd be only 1/2 cent per dollar, according to what the house is worth. That's 99% off the value of the home. And then let's go even crazier. I mean, that's obviously a great deal, but imagine the seller even paid you to live in that house. And by year 9, you'd received all the money back that you had paid him. And that's incredibly what happens with every single bank on yourself type designed policy that we help set up for our clients. That's truly a remarkable deal. Now, the only other thing I'll just mention is imagine you could buy more than one of these houses over your lifetime. These policies, you can have as many policies as you want to have. There's no requiring that you have just one. How many houses would you buy if this was the deal you were offered? So if you'd like to learn more about this, man, I'd love to chat with you. Talk to me for 15 minutes, see if this is a good fit. You can go to lakegrowth.com/schedule. That's SCHEDULE, schedule. Click on phone introduction. I'd be happy to answer your questions. I'll include the link in the show notes. But man, I'd say, one of the best things, most important things we can remember is our money is going to have to live somewhere. Where's the best place for it to live? It's going to cost something to live in a savings account. No interest, taxable every year. The banks get to use it. It's going to cost something to go into the 401k or the brokerage account or the IRA or your real estate, which has property taxes every year. So anywhere you put your money, it costs something. The question is it worth it? And what are we buying for it? So I hope this idea has been helpful for you. And remember to like the video and subscribe to our channel so we can share more ideas with you. Don't forget to leave a comment. Maybe I'm missing something here. This is your chance. I'd love to get your thoughts and feedback. Thanks, guys.